Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I will be discussing foreign exchange trading, and then I'll dive into the Dow Jones and this week's stocks of interest. Now, before we jump into the report, I'd just like to mention that if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel. So let's get into this week's report. The foreign exchange market, which is also referred to as the FX or Forex or currency market, is the largest, most liquid exchange in the world for buying, selling or exchanging currencies. While the main participants in this market are the institutions, it was open to the retail market in the 1990s with the introduction of the internet and Forex trading platforms. In essence, Forex brokers allowed their clients to trade on margin, or in other words, to leverage their investment in this market. Given the attraction to the foreign exchange market by so many traders, it is my intention in this week's market report to discuss the opportunities as well as the risks available to you when trading these markets. In our previous two reports, we've covered the factors that affect currency prices, as well as how these prices affect the stock market. So I thought this topic would follow on nicely from our previous discussions. Now, before we get into the nitty-gritty of Forex trading, let me take you on a trip back in time to learn the basics of how the Forex market became what it is today. Currency trading is definitely not new. In fact, in some form or another, the exchange or trading of currencies has been around for thousands of years. An example of this is where precious gold coins were traded in biblical times as a means of purchasing clothing and food. Prior to 1973, trading or speculating in foreign exchange was not permitted due to the Bretton Woods Agreement. The agreement was set up in 1944 in an effort to stabilize international currencies. Basically, the Bretton Woods Agreement fixed international currencies against the US dollar to create a new global monetary system. Under the system, countries were required to maintain fixed exchange rates between their currencies and the US dollar rather than the gold standard, which tied the value of a country's currency to the amount of gold it possessed. However, in the early 1970s, the US was suffering from a combination of inflation and recession, which resulted in an overvaluation of the US dollar and the collapse of the Bretton Woods system in 1973. This system was subsequently replaced with the managed floating exchange rate system as we know it today. If you've ever transferred money or travelled overseas, then you would have completed a foreign exchange transaction. For example, let's say you wanted to convert Australian dollars to US dollars as you were planning to go on a holiday. The foreign exchange rate between these two currencies, or the currency pair as it's known, will determine the amount of US dollars you receive. And if you remember from my previous market report, this is based on supply and demand, which is continually fluctuating. But what if you want to trade foreign exchange as part of your investment strategy? If you have ever surfed the internet to learn about trading, you would have come across the many advertisements and options for trading Forex, as it's become a very popular option for those wanting to build their wealth or supplement their income. Indeed, trading in the foreign exchange market has never been easier, given that it operates continuously 24 hours a day except weekends. But let's consider whether this is actually a good thing. For example, when trading the foreign exchange market, you can leverage on a margin of 10 to 1, which means if you invest $1,000, your exposure in the market will be $10,000. Now let's say you decide to trade the Australian US dollar currency pair because you're speculating that the Australian dollar will rise in relation to the US dollar. Now let's assume the trade goes in your favour and you make 10% on the trade. On your investment of $10,000, you will have made $1,000. But given the exchange rates are continually fluctuating throughout the day in the foreign exchange market, let's assume that instead of the Australian dollar rising as you expected, it fell by 10%. Now you would have to pay the $1,000. Now let's take this one step further. You may or may not be aware, but in the foreign exchange market you can trade on a margin of just 1%, which means your investment of $10,000 would equate to an exposure of $1 million. So if we repeat the previous exercise and assume you make 10% on the trade, you would have made $100,000. But what if instead you lose 10% and you would have to cough up $100,000? Now I can hear some of you saying, ouch, but believe me, this is a reality for a lot of traders who are inexperienced in trading the Forex market. And this is why many refer to this market as a double-edged sword. Just because it is easy to trade Forex markets does not mean it's low risk or easy to make money in. In fact, in the FX market, it is completely the opposite. So I implore you to heed my warning. The FX market is high risk and more traders fail in this market than any other, and in a lot of cases end up walking away from trading altogether. But this needn't be the case. As many of you would understand, once you know how to drive, you can drive any car in the world, and so it is with trading. Once you know how to trade, you can trade any market in the world. But you must first learn how to trade in a low-risk environment, such as the stock market, well before you consider trading the Forex market. Now I know some of you will ignore my advice, believing you know better. But let me ask you, if you haven't proven to yourself that you can make money consistently trading the stock market, why would you believe you can make money in the high-risk environment like the Forex market? Some of you will have heard me say this before. When it comes to trading the market, there's a vast difference between knowledge and understanding. Understanding the Forex market does not mean you have the knowledge or skill to trade this market. Indeed, as many of our clients who have gone down this path will say, the FX market is only suitable for traders who have demonstrated they can consistently take profits from the stock market. And it is definitely not the place to start your trading journey. Another important consideration when trading the FX market is the volatility you are exposed to. Given this, you need to implement solid money management rules in order to protect your capital. Not understanding how to apply these rules correctly in highly leveraged markets is another reason why so many traders struggle with trading Forex. Remember, trading is not about how much money you can make. It is about how much you do not lose over time that makes you wealthy in the longer term. While I do appreciate the fast and sexy appeal this market portrays of high risk, high reward, in reality most experience high risk with a fatal churn and burn to their bank account. So if you are serious about your success, I encourage you to gain a solid education that teaches you how to trade so that you can then develop the confidence and the competence to trade any market in the world, because a trader is who you become, not what market you trade. Now, before we get into this week's stocks, I did mention that I'll let you know how to get onto the live forum that I'm going to be conducting. That's the one where I'm going to be talking about the market, stocks, and answering your most burning questions. To be able to access that forum, you need to be a subscriber of this channel. But for us to let you know how to get onto the forum, you do need to email us at info@wealthwithin.com.au. On the email to info@wealthwithin.com.au, you need to put in the title, the subject title, YouTube, and in the body just put your subscriber name. I don't need any other details like phone numbers and addresses, just your subscriber name. And what we will do is we'll send you the link to get onto that forum when we do have it. The forum will happen once we've got 1,000 subscribers, which will happen in the next week. So we'll be sending you an email saying, here's the link to get onto that forum. So remember to subscribe to the channel today and shoot us an email. So let's get into this week's stocks. Okay, let's get into the charts at the moment. And on your screen, I've got a monthly chart of the Dow Jones. We've seen obviously a lot of volatility in the market over the past month. And I'll bring this down onto a weekly chart into a second. But looking at this, this is the same chart you saw last week. We're looking at the current month, which we're only well, a couple of days into it, but you can see here how the Dow over those last couple of days did okay, and it's slightly up, which is an encouraging sign. But how long is it going to be up? So here's last week, which is the week ending the 2nd of November. That weekly chart or weekly bar encompasses all the data for that week. So when you're looking at weekly bars, it does title them the end of the week, not the start of the week. And sometimes that confuses new traders. There's all sorts of stuff we teach in our Trading Mentor course and our diploma, just so that you understand what you're actually looking at. At this point in time, it has moved down 1, 2, 3, 4 weeks. Be interesting to see what it's doing this week or how far it goes. Let me just get rid of that so you can see. It has broken previous troughs. Here's the last, or the one that hasn't broken yet, 23,997. It did get close at 24,122. So to me, I don't think the Dow's fallen back enough. We may get a few weeks up in terms of where it might go. Interesting things will be to see how far it does actually go up. And that will tell us the longer term direction of the Dow in terms of where is it likely to fall further? Because obviously that was a new all-time high on the Dow. Very small bar, closed lower, and it made a new all-time high. The S&P made it just slightly earlier, but it did make a new all-time high. But they're pretty much traveling around the same for themselves. But if we look at this, and if I put, I don't want that. Where is it? I want to put this on, and if I go to there, and that's not the one I want. There we go. Let me look at this and click on here. Now I'll click off some of these little levels so that you can see what I'm talking about, and we'll get rid of that one there. So right now, of that move down, this bar hit right up about at that 50% level. So for me to be comfortable with this, you want to see it rise up way past this level to see whether it's going to break that. If it doesn't, if we get to this thing, let me go back here again, click on this. If we get there, if it gets up to this level here and starts to fall away, 26,244, and starts to fall away again, then it will be highly likely it will break below that 24,122. Interesting, I was been writing some articles for US News, World News and Media, Value Walk, another publication I've been writing for in the US, and there's a number of other ones that I've been writing for, and just saying I don't think the Dow's going to crash, and I've had a few journalists. I don't think it's going to crash. I think it's going to pull back slightly. Well, not necessarily slightly, but it's going to pull back. So if I go and look at, there it is. So what I'm thinking with the Dow is you're probably going to get something like this and something like that fall away into that sort of 22, maybe down into $21,000. Now, I'm not sure how high this will go, whether it'll go right up and make another high up with this and up equal to that, or how far up it will go. But this is sort of what I'm thinking, which is somewhere in the realms of 15 to 20%. So you can see at 20%. So somewhere between about here, roughly, I'm thinking, or just below these sorts of lows here, and or down to there. That's what I'm thinking. But it'll be a slow pullback over many, many months. I don't necessarily think it's going to happen overnight and be a crash. And crash is 25%, but it will be a correction of 15, roughly 15%. It could go 20, but 15 is probably more what I'm looking at. And there you'll see there 15% from its high is around about that sort of level, around that just above 22,000 points. So, but right now, would I get excited about the Dow? No, I'm not really excited about the Dow. If it makes a new all-time high and doesn't do exactly what I'm thinking there, all it's doing is pushing out when it's going to have that correction or that pullback of that 15 to 20%. That's all it's doing. If it does something like, let me get rid of this. If it does something like this, it'll be quite vertical. It'll be very fast if it does something like that. And when it goes really fast, that means it's increasing the probability that the end is happening, and then it'll come the other way. So as I said, I'd prefer more of a gentle slowing down of that market and coming back into those areas that I talk about, because then people can just adjust their portfolios nicely and really just stick your stop losses down. If you've got stocks in the US market, just have your exit strategies there and take them, because as I said, it's highly likely that it's going to be falling 15% and probably it could go up to 20%. Today I also wanted to cover the banking stocks in the US. I've covered them in the Australian market one for the Australian market, but let's have a look at the banks in terms of that. Interesting one. I find the banking sector in the US is quite interesting in terms of banks pretty much run the economy, and they're pretty much to a world of their own, and regulation is a hell of a lot tighter in Australia and other countries around the world than they are in the US, although it's a little bit easier in the US in terms of regulation. But you can see here, if I scroll back with Citibank, look at that. Citibank, its all-time high was way back in August 2000, long before the GFC. And then we go to here, and we see here December 2006, it was already falling by the GFC. Remember, markets, the Dow made a high probably around about here, and Citibank was already falling. So a lot of people don't think that when you're getting into those big pullbacks that you don't get warning signs. You do. You get truckloads of them, especially with good stocks, and that's really why you stick to good stocks, because they'll always tell you in advance what's going on. So what's going on through here, and if we just go back here and we get rid of that so that we can see here how this is unfolding. Right now, Citibank's a little more bearish. It had a high here in January, and it's really below its lows, and obviously that made a lower low. So I don't think its downward move is actually finished yet. I don't think we will probably see a bit more of a fall on Citibank here. I think it's probably going to come down to that $57 mark before it finds some support, but that's all it is. Excuse me, a little bit of a frog in my throat. But if I look at this sort of thing and look at the momentum that it's got at the moment, if we just start joining the dots, you can just start seeing that it really does sort of run around this sort of level in terms of its momentum and volatility at the moment. And so it comes up, plays up around this grey line all the time. So if it does come down here, it will then move back up to here again. So it could be something to watch for the more medium to longer term. Okay, so let's get on with the next stock, and this one's Wells Fargo, a very long or old American bank, and it is looking quite nice. It's been quite bullish. If we go to the weekly chart, you can see here how it's beautiful. It's just had a new all-time high back in January of this year, a little bit earlier than the Dow, and again, it sort of supports my view that the big stocks will be bearish before the market will be generally, because you're seeing that the people with they start getting out of these big stocks because the big end of town are in these sorts of stocks because of the weightings, the index weightings and index funds and those sorts of things. So they start lightening their portfolio, which starts bringing these sorts of stocks down. But also you get people thinking, oh, look, Wells Fargo was only $30 a few years back. Oh, $66, it's too expensive. And so that's how they think. So they go for what they believe lower cap stocks or lower price stocks, thinking there's more value in those. And so you see the buying slow down on these bigger stocks, which gives you the signal that the market may be tipping over, and the market goes secondary to these sorts of stocks like your Citibanks and your Wells Fargos, your big stocks. So it's giving me a warning signal from the Dow saying, well, the Dow is likely to pull back. But the opposite happens as well. These guys start to go up first rather than the more lower cap stocks. But at this point in time, it is looking a little bit more bearish because it's broken the previous low here of wherever that one is, 50.26, as you can see there, 50.02. Likely a bit more falls here. I don't think it'll fall too much, this stock. It'll probably go down somewhere around there. It may break just below that. So if you've got banking stocks in the US, I think it's probably time to sort of lighten your load on those sorts of things and have a good look at what you're doing and have an exit strategy on them. Bank of America, a little bit different. It looks quite nice, doesn't it, Bank of America? It has had its all-time high back in March, so it had its a little bit later. Obviously, Wells Fargo was January. This is March, a few months later, but still been a little bit bearish and broken previous lows. If we look at all that, broken all those lows through here. Let's look up the monthly chart, and you can see it's a little bit more like Citibank, isn't it? Look at that. So you're seeing its all-time high back just before the GC. That's November 2006. Remember, the Dow was making highs in September and October 2007, and yet that's all around here. So these were already falling at the time the GFC peak was happening, or the peak prior to the GFC. So really nice move up here. Right now, it's seen how it's gone vertical. It suggests to me it's running very hot through here. So it's got to come back a little bit. So how far will this come back? Look, I think you're going to see at least come back to around about sort of that $22 level. I think it'll come back around into there. I don't think it'll go below that, but it'll just bring back down to that. If we use our trend line tool, wherever it is, and I'll go and use this one. If we look at this sort of thing and we sort of connect some dots through here, you're probably looking at somewhere around that grey line. It should just come back down into that sort of area there. With it may come a bit lower, but we don't know, but it'll be up and around that. That sort of looks like it's momentum at this point in time. If you look at that, you can see these peaks and troughs through here. So it's broken below that. But as I said, to me at this point in time, it does look like it's going to fall away a little bit. Here's American Express, another great US company. It has this, it looked beautifully bullish, had its high in September. It's had a little bit of a pullback, broken that there, but it does look like it's bullish, and it looks like it's going to continue to be bullish. It did close higher last week, so I actually like this stock. And would I buy it right now? No, I'll just be sitting back and watching to see what it does a little bit. But it's a lot more bullish than either Wells Fargo, Citi, or Bank of America. So all of these. So that looks reasonably bullish, but I think it's a lot more bearish than bullish at the moment. That looks a little bit more bearish. Citibank looks a little bit more bearish, and American Express looks all right. So it's not too bad there. But do really have a good look at what your portfolios. If you do have banks in your portfolio, I know a lot of people. They like to do weightings or sector weightings. Just don't do that. Even Buffett doesn't do that, and it's really strange that people think I've got to have a percentage of my money in banks, and I've got to have a percentage in telcos, and so much in technology, and so much in materials or energy or whatever it is, the sectors, and you don't. All you want to do is own stocks that are going up. That's all you want to do. And so, when I read one day that Buffett doesn't do sector weightings, I go, great, he just thinks like me, because I don't care whether a stock, what sector is in, as long as it's going up. And I hope that makes sense, because it's the whole idea of having a portfolio, just to get stocks that are going up. Right now, JP Morgan Chase is looking like it's running out of steam. We've had a high there of 119.33. Here's our second high, 119.24, slightly lower. Suggests it's a bit more bearish. Right now, it's sitting there, that low there at 102.73. It's just slightly above that 102.20. Be interesting to see what it does this week, but if that low there gets broken, then it's got a fair way to go down. So I'd say there's a nice move down, nice little double top there that would suggest it should go a lot further. So I'd be staying out of JP Morgan at this point in time. So I pretty much wouldn't be any of these banks that I've been mentioning on the US. If you are in them, just make sure you've got stop losses or an exit strategy. If you don't have an exit strategy, then you're taking higher risk with your money. As always, if you need me to look at a stock, or you want me to have a look at a stock for you need to comment below. So this is for the US stocks. So any US stocks I'm quite happy to look at on this report. If you do have any comments, please, or questions, please comment below, and remember to subscribe to the channel, because that really helps us, and it helps you find our podcast, our YouTube videos. When you open up YouTube, you'll find them quite easily. So subscribe now, hit the like button, give us any comments you like, and if you've got any stocks, put them there too. Good luck, good trading. I'll talk to you next week.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.